I have to say that I've found this an interesting challenge over the last 5 or 6 years to try to work out where an economy is going. Because I think a lot of the old principles or the new principles of economics have been proven to fail. Because the one thing economists can tell you is that mostly they get their predictions wrong. And therefore, what we're looking at a lot of the time is trying to look backwards to work out what's going to happen going forwards. I'm not sure it quite works that way, given that we're actually in some quite interesting uncharted territory. And I've almost gone back to, and I went back to when we got into this crisis, digging out my old economics books and going back to almost Keynesian economic theory, away from some of the more modern stuff that we've got. And you'll see as we go through this, actually, the things that are driving, when Mark Carney talks a lot about the economy, are more traditional economic issues than perhaps some of the more modern theories that have been prevalent during perhaps the 90s and the years 2000, and we reached the peak of the crisis. And we're probably back in a more fundamental view of how economies work than we got to during that, I'll call it, experimental period. What I also want to talk about, particularly as we talk about the economy, is the current account position, where we are in gross domestic product, where we are in employment and unemployment, where we are in wage inflation, where we are in government expenditure, where we are in debt, and where we are in consumer price inflation, and how that all meshes together to create the policy position we've got. And then we'll relate that into the housing market and then the mortgage market. So an awful lot of chunky stuff around where the economy is to begin with. Now, UK current account, quite an interesting challenge. This is actually the thing that drives a lot of the fundamentals around the economy. Because this is actually the amount of money we have to borrow as a country to survive in international markets. But what we see here is that over a period of time, we'll come back to this, is investment income, which used to be a great surplus, has been dropping off and going negative for some time. Our trade balance has been getting contracted, so we're not making as much money. And the thing that used to keep us when I was a boy in the black is this thing called current transfers, which is a lot of the financial trades are still there, but actually now in deficit. So the whole thing, particularly latterly, is dragging us down into a deeper and darker place. Because our trading hasn't been going very well, and the financial imbalances we'll come to in a minute have been causing more and more problems. And this is a percentage of nominal GDP. So this is actually based back to people's incomes as well. And this actually drives some quite interesting issues. And what we can see here is that the UK current account is continually getting in a declining position when the Tory party is talking about a better and improving economy, and Labour Party say, no, fundamentally it's getting in a worse place. Both of them are right. Because domestically, our economy is looking better and stronger, which we'll come to. But in the bigger, wider world, we're actually got some fundamental issues that are driving some of the thinking about where we are in our borrowing and debt and interest payments. And what you're seeing here is earnings on particularly, so what you've got is earnings on debt beginning to cause big problems for us, because the money we earn from the debt we own abroad has been reducing, and the amount of money we're paying out for people who've bought UK debt is increasing. And that's actually causing a fundamental cash flow out of the UK that the government is beginning to struggle to deal with. But while the UK Debt Office can used to be able to sell gilts, it's okay, but the pressure is mounting on that. In the same way that Greece and Portugal and Spain and Italy have problems, this is a mounting problem for the UK. So we have to be very careful about some of this as we're seeing the world move forward. And actually what's causing this is quite fundamental, and why the government talks about some interesting things. And you look at what's caused this back, comparing our trade balance back to 1971, and you can see it's this trade balance that has caused most of the reduction, going back to 71. So our ability as a trading nation in the last 45 years has diminished significantly. And since 1985, it's trade that has caused the problem. But since 2011, it's actually our cash flows around money coming in from overseas debt and the amount we're paying out to foreign nationals that's causing the problem in the shorter term. So what's cyclically causing issues here is a change in fundamentally how our money is flowing. Our money is flowing in and out of the country. And that's particularly shown by this graph, in that what this shows is, as a percentage of GDP, the international investment position. So this is all the Chinese and Russian money coming into London and creating that property bubble, and people having to repatriate money from abroad to survive, and us not having income from foreign investments in the same way that we did. So all of this is what's causing this vast shift, which George Osborne certainly doesn't want to talk about, and Ed Balls hasn't got the ability to talk about. Did I say that out loud? That was very wrong. But that's where we are. Because this begins to mask, because the problem with Ed Balls starts to talk about this, someone will start asking, well, how are you going to turn this round? And that isn't an answer to that question. Because this is actually really quite difficult stuff to fix, because this is about the emotion of how people, we are in a global world now, and money moves globally. And you find it very hard to stop that happening without exchange controls. And therefore, it's only if you bring exchange controls back do you begin to be able to control some of this thing that's going on. So we've got some interesting dynamics happening around this process. But in this domestic world, rather than that bigger picture of where money flows, GDP looks okay. The big bonus for George Osborne, lucky chancellor, is that it's been going pretty well. So we've seen this drive upwards of GDP up towards that 3% figure, and the Bank of England predicting that in midterms it's going to continue to flow through between that 2 and 3% all the way through 17-18. So the domestic economy is looking relatively robust, quite positive in terms of the current latest projections under the inflation report from February 15. So that all seems fairly positive. But what's driving this? What's underlying that? And the interesting part is looking at what's driving this is still growth in the service sector. So this isn't real stuff. This is fluffy. This is Next and John Lewis getting better at selling things. And what you see then is what's happening on construction. So you can see the impact of the Conservative Party, the coalition initiatives to try to get construction working again. So it's driving upwards, but off a very low base. That's the problem. And you can see where we are also around manufacturing, where manufacturing gradually clawing its way back, but still not back to its peak, go back to where we were pre-crisis. So we are in a situation where manufacturing and construction are still not in as great a place as we want them to be. It's still the service sector that's driving an awful lot of what's going on in our economy, which can't be great for a long-term, sustainable, strong economy in the future. But what that's driving is great numbers on total employment. And it is one of these great things that they talk about the number of new jobs created in the UK, and therefore this is a stunning little piece of performance for any government to see the way we've created new jobs. The debate, of course, is whether these are real full-time jobs in the economy or whether it's zero contracts and other things that sit there. But then you get to this next one, which is this one, which begins to look really interesting, because what you see here is employment growth all the way through 14, which shows male employment is being this line, which has grown a bit, but female employment is growing much faster than anything else, and has been growing significantly more all the way through the recovery cycle. And what is causing, and that's interesting, because is this all part-time jobs, is it full-time jobs? Well, the answer is these are predominantly full-time jobs. And this is an interesting part of our economy. Not what people expect, unless you really look underneath the numbers. And the other part, which is also interesting, part of all this, sorry, I go back, is, is what's happening on unemployment rates. So the projections on all of this were the 3-month unemployment rate, and this is the way that's been falling, and the projections there are where they thought this would go when they did the inflation report in November, and where they now are in terms of predictions in February. So you can see that the continual projection is that they see unemployment continuing to track downwards under 5.5%. Now, why is that interesting? Well, in every economic model that's ever been run historically, when unemployment drops below 6%, you normally see wage inflation come back into any economy. What we have seen is not significant wage inflation come back into the economy yet, although unemployment is tracking and looking to track down closer to 5% than 6% now within the near term. Therefore, you'd normally expect wage inflation to come back. What I think has happened is that we've actually managed to manage out expectation of pay rises because we've had such a long period of no pay rises. And therefore, it's taking that expectation of inflation out, and when people are seeing consumer price inflation at lower numbers, the drive for a natural pay increase of 1% every year for everybody isn't in the same place, or 5% for everybody isn't the same place as it used to be. So it's about people's psychology having changed over time. What you also have is changes in where that unemployment sits by duration. So under 6 months, they've managed to make big impacts in. Over 12 months, they're beginning to manage to somehow address that hardcore unemployed, and the 6 to 12 month number, they've also begun to get some control over. But for any government, getting that bit is the hard part, because it's getting that long-term unemployed back to work that fundamentally helps you in the long term, because it begins to address some of your social care costs, which we'll come back to in a second. So you can see this has got some really big stuff around it. And this is beginning to show you where we are now around earnings growth versus real wages. So you've got consumer price inflation, which has been running, and average wage earnings. So price inflation has been reducing. Average weekly earnings continue to go up. And therefore, growth in real earnings for the first time has begun to reach something meaningful in real terms. An announcement this morning that average earnings is now back above the peak level because we had periods where earnings were not growing and inflation was in a certain space. So we are now reaching a place where real earnings is above where we were at the peak of the market. Now, this is fundamental to a message around where we are. But the other part is how much of this is regional and how much of this is just in London and the South East. And that is data that's very hard to get hold of, I'm afraid. But I know from all the things we talk about, it's London and the South East that's doing better in this than the rest of the country. And that's quite fundamental to understanding some of the dynamics that we'll see in a minute. The big issue, of course, is that despite what everybody says in government spending is still continuing to grow significantly. Because measured against nominal GDP, we're seeing government spending still continuing to escalate as a percentage of GDP. And GDP is still growing. So GDP is still growing, and real spending of government is still continuing to grow, despite the fact that they're talking about contracting and contracting and contracting in certain areas. And why is that? Well, it's because we have this small problem called social protection. We've got really tight controls on things like defence, on things like an education that they've got some control over, but they cannot get a handle on this social protection bill. So whether that's health service or social security payments or old age pensions, that's what's causing the fundamental drive there that they can't get a lid on. And therefore, the need to somehow control this and get this into a better place is a fundamental part of what the next government will have to do. And that's why you're hearing about this gap, this election issue around, are the Tories going to take us back to 1930 spending on areas like unemployment benefit and social care? Because that's the reason, because they know they've got to try and get this under control somewhere in order to get our economy back into some better place. And you can see this around this, because we're still seeing net debt continue to grow. So the government isn't actually reducing its debt mountain at all. We're still borrowing more every year than they're taking by way of tax. Therefore, that debt mountain is continuing to grow all of the time. The one bit we've probably been relatively successful in is stopping the UK personal debt mountain growing. Because actually you can see this personal debt mountain that went up hugely during that period from 96 to 7. But where did it grow? It grew a little bit down here in credit card debt. It grew to a degree in other consumer debt, unsecured debt, and that's actually relatively come under control. But it's this thing here. All of that money, that £1 trillion that flooded into the housing market, and I know Linda will come back and talk about this possibly later, this £1 trillion that only fueled house price inflation. So all that did was fuel house price inflation and people getting pissed up in Marbella or new cars. We have now got the biggest hangover in the world because of this, because we took all this money as consumers and spent it. Housing prices went up, but we also took the money out of our houses, went abroad, and pissed it against the wall as a nation. I was saying to Aileen the other day, my generation owes her generation a great apology, because what we've done is actually done all of that, had the party, and now we expect to be kept for the rest of our lives as we get older and older and older, and leaving them with a debt and an ability to have housing and growth in a way that we could never have imagined by not being very responsible in here. And when the regulators, in their broadest sense, whether it's Bank of England, Monetary Policy Committee, Financial Policy Committee, FSE, talk about this, it's because we're now having to swallow that pill and deal with it, and the debt mountain and the credit costs of that. And whilst interest rates are low, that doesn't look too painful. We'll come back to that in a second. Because this is costing us that a year, 55.4 billion. If interest rates go up significantly, that number begins to shift quite enormously. That 55 becomes 100 billion, and that's money you then can't spend in the economy. That's therefore what's driving a lot of the thinking at the moment about how do we move forward out of a low interest economy, or how do we maybe not move out of a low interest rate economy for a very long time in order to get this in the right space. All of that against a backdrop where inflation has hit a brick wall. Is that a good or a bad thing? Interesting. Because it always looks good, but you've got to remember the Monetary Policy Committee has a target to keep inflation at, or as close to possible, 2%. because it's accepted that a certain amount of inflation in the economy is good and required. What we don't want is deflation. And what is being predicted at the moment is there's a high probability in here, from the Bank of England, the last inflation report, that we will see inflation drop below 0%. And that is technically, potentially, deflation. But it's why it's quite important. Because in a normal economic model, you worry about deflation because money in the economy is contracting, things are going negative, output's dropping, you get to a horrible place. That's normally something you worry about. This is being caused by world commodity prices, and we'll come on to that in a minute. That's being caused by world commodity prices moving, dragging pricing numbers down, not being caused by nasty systemic things in the economy going the wrong way. Because in the old Keynesian model, what you wanted was current account balance, positive, unemployment within around that 5% figure, positive, inflation running at about 2%, and a positive environment looking forwards about the world. And trying to get all of those things working together in a straight line is almost impossible. Nobody's ever managed to do it for long. But this, therefore, what the Monetary Policy Committee are saying is that they don't expect to see inflation back at that 2% figure till way out, probably in 2017 or 18. Therefore, that's driving a thought that says 0.5% base rate might be here for a long time to come, and maybe we need to go back into more asset purchase to expand on the 375 billion of quantitative easing that's in the market already. So these trends are such that the chance of getting back to 4% inflation in any reasonable time frame is nil. The chance of it still being negative by that period is there. And that's their current view, and that's shifted a long way as that number's dropped quite quickly. What will happen, though, is if oil prices change, then things will move quite a long way. And you can see here that under the November report, that was their expectations on CPI, and that's now their expectations 3 months later. This moved that far in prediction terms in a 3-month period. So the brightest and best economists we have in the country were thinking there. 3 months later, they're thinking there because oil prices shifted. And what we have, though, is also stuff around capacity utilization that means that everybody's thinking, actually, we've got a lot of positives running in the economy and things are still looking and feeling better, despite all of what's going on. The general UK position is things are getting better. But this is what's caused the problem. This dollar oil price, where they were expecting that to be the oil price, they were expecting a shallow fall off when they met in November, and they're now saying we might see a tracking back upwards, as we are beginning to see from that bottom of $50 a barrel as we go through the next period of time. But that oil price has had a major effect on what's going on. And not just the oil price, because what you can see is the oil price here tracking downwards, but also tracking downwards has been agricultural prices, i.e. commodities, and also industrial metal prices tracking downwards. So what's happened is, as China and India economies have started to slow down, world commodity prices have dropped off. And that's what's causing a reduction in inflation in the UK, not anything systemically within our domestic economy. So therefore, you've got to be very aware when you're making judgments about what the drivers are as opposed to what you might have thought they were. And this is actually an interesting thing. So if a 10% fall in oil prices happen, this is what happens to inflation. There's a direct effect, the effect on price and world demand, and then the indirect and domestic effect. So you have a long-term effect on just a 10% reduction in oil price, and we've seen a 50% fall. So you multiply those numbers by kind of 5, and you see why the impact of inflation has been huge. And it runs for a period of time as it trickles back out. And it will take time for this. So I expect oil prices to come back to $100 a barrel at some time. How quickly that is will determine how quickly that inflation outcome comes back out the other way. And what we're seeing is, and this is from other forecasters, i.e. not them, their expectation of consumer price inflation is that it will be a long time till it gets significantly back above that 2% figure, which the government deemed to be tolerable. GDP is still going to run at that, not massive, but great figures. Unemployment is going to continue to track downwards towards 5%. And there's an expectation that base rates will go up, but we're not actually talking about base rate that looks that nasty until we get into 18 now. It's still a long way out from where our expectations are. And there's an expectation at some stage they might start to repay part of the quantitative easing program, but not to a huge degree. That's a long, gradual program of repayment. And sterling weighted against other currencies at a fairly static level. And this is what the MPC's key judgments were as they came out of their February meeting, was they expect sterling to continue to appreciate. They expect house price inflation to still begin to run at around some much lower figures, and they expect mortgage approvals to drop from where they've been. So, and they expect credit spreads, which have ticked up, to start to decline. So there's all sorts of expectations built into where the MPC think they're going to be and why they have been thinking about cuts in base rate or more quantitative easing as a signal to the market that their medium-term expectation is that the economy is going to go through some difficult times, but not from any of the numbers you've seen there. Disastrous times, because you still have inflation under control, you still have growth, you still have employment increasing and unemployment falling, and some of that happening in a good way. So it's against what we have is a positive economy against a backdrop of real international problems, and that's where you have to keep the context right. So how does that feed into the market that we're more interested in, the housing market? Well, what we have seen is, looking at the nationwide house price index, things go quite well, and then over the last few months begin to cool quite significantly. And we are now seeing real evidence that house price inflation across the country is beginning to come off its peak, and even in London we're seeing the numbers begin to rein back into acceptable levels. Why is this important? Well, it's because if you go back and had heard me speak in 2009 and 10, I talked a lot about the fact that the Bank of England wanted house price inflation to run at about 0 and wage inflation to run at about 3%. Because in a 10-year cycle of that, then house prices in relation to incomes would get back into a reasonable level. Therefore, you get back to a better balance. And that avoids what's happened in other European countries like Spain, in particular France, where house prices have fallen by significant degrees. And therefore, their banks' balance sheets had to be restructured, and some not restructured, to reflect the fact that their underlying assets are now worth an awful lot less than they were. In the UK, we've taken a different route where we've tried to drive interest rates really low, underpin things, and work our way out of this on a gradual basis. And therefore, the challenge for us as industry is to keep house price inflation under control while wage inflation comes back and get things back into some form of kilter, and we'll see why. And the other part, of course, is what we've seen is regional house prices, we do not work in one market. And the one problem all of our regulators have is that they have this London market which runs a very interesting number of price relative to 2007 peak, where London is still 25% ahead of the peak, and the bit that you're involved in here, you're at about 8% below the peak still. And therefore, and you go to Northern Ireland and other parts of England in the northwest. So we have, in fact, I would argue we have a market inside London, inside the Circle Line. We have another market inside the M25, and then we have the rest of the southeast. That's another market, the people who commute to London. And then there's the rest of the country that are still in an entirely different place. And therefore, trying to do any policy changes that are blunt instruments that work across the whole market when you have, in fact, probably 5 or 6 different markets is almost impossible to do. Which is why we are seeing some of the housing issues devolved out to Ireland, to Wales, and to Scotland, because you have different issues. And it's probably the right way to go. But the macroeconomic stuff is done across all of the UK, which is probably unhelpful. Does that sound like a plea for Scottish independence? Probably. And the other part, of course, is what I'm talking about here, this house price to earnings ratio of affordability. And we have seen this across the piece tick up again, which is what's causing concern. Because as we're seeing that come down and house price to affordability there, that was okay. To see this tick back up isn't the right place for us to be, to get us back into a better economy. But what is the reason for that? Well, the reason for that is simple. We're not building enough houses. The money flowing in means we don't build enough houses. And you see it here, where across, in 2014, house prices to earnings ratios across the country are very different. So in Scotland, canny buyers, never got themselves too far out of kilter, are quite sensible. London South East, bunch of nutters who keep paying over the odds for property because they have to. But that's reality. It's the economic reality of what you have to do to get on the ladder. But it is crazy that you want to have to pay that much for property in comparison to what you can get in the rest of the country. So therefore, actually, what you have is people not paying as much for the house and therefore actually having more disposable income and a better lifestyle, a better balance. But it sometimes doesn't feel like that, I know. But that's the reality. And as a percentage of take-home pay, you can see that in here, where you've got Scotland down here as a first-time buyer, mortgage payments as a percentage of take-home pay, much more sensible than you're seeing here. It's really painful and hard to do for people. And therefore, you see some different lifestyles around the country because of this. Is that why Newcastle on a Friday night is the place to be? And And it's this, and first, as a percentage of take-home pay, you can see this is tracked down over a period of time, because this is where we had to get back to, because that was really painful in '89. That got way out of kilter as we moved into withdrawal of stamp duty, and we hit that big crash. Too high in there, that causes things to go wrong. And if we see that tick up again above that 40% line, then it's a prelude to something going wrong. So this is where the policymakers, this is what the policymakers are looking at in broader economic terms to avoid these things happening. Really quite important in the way they think about things. And also you can see by transaction type what's going on, that they were seeing this transaction levels based to 2006 back to now, gradual improvements across the country, but nothing dynamic yet. So we're not seeing a great return, which given that actually house prices are in a better place, people are trying to build houses, interest rates are all-time low, why is more not happening? And maybe the head-scratchy bit for policymakers is why is there not more dynamism in the market? It is beginning to come back, it is beginning to come back in here, but not at the rate people want, and therefore it's an interesting challenge. And we are seeing this issue around housing starts and completions here, where it is all ticking upwards, it's going in the right direction. But there is a worry that having cleared out what was in the builders' stockpiles, they're in half-completed property transactions in the south and England last year, there's now a problem as everybody's now selling off plan again now, and therefore the lead times for transaction levels are beginning to pull out, and we aren't getting an energy of people wanting to move house. There's still an awful lot of extensions being done all over the southeast of England other than people moving. And the other part, of course, is we've seen this issue. Everybody talks about what percentage is cash transactions rather than. It's an interesting one that we'll talk more about as we go into the European Mortgage Directive, is how many people might borrow abroad and come in here and look like they're a cash buyer, but have got borrowings abroad, and do we understand what's going on? But all of this is a gradual increase over a long period of time, particularly as we've seen money flow into the UK, of people paying cash. And maybe that's part of the buy-to-let market as well, where people will raise money on another property and pay cash for a buy-to-let property in part of the country. It's part of all of this shift, which of course is very hard for any government to control through interest rates, because that is a big part of any housing market that they find hard to touch unless they put really strict controls on who can buy which type of property, or put some interesting caps into exchange controls on how money comes into the UK, which of course would cause a great deal of political reaction from other countries if we decided to do that. So this is quite a hard one for people to control as a policy issue. So that's the housing market, which is a bit all over the place. Scotland's a bit different to everywhere else, which is good. And this mortgage market is also different, because we're seeing, and we have some interesting debate around this, mortgage applications versus approvals, and what they're for in terms of house purchase and transactions as a whole. We've just provided some data from one of our largest members into PRA. It's data that I know that the FSE have seen before from us, and we've taken into Europe, which is how many transactions do a broker have to do to get to a mortgage application? How many people, how many frogs do you have to kiss to find a prince? And the answer is broadly 4. So you have this firm, a very big firm, for every 2,500 applications they can submit, they have to talk to 10,000 people at the front end. Now, that means that they're working bloody hard, and any of you know out there, you have to talk to a lot of customers to get somebody who can actually get to that application point. And none of that gets captured in any data that the regulator sees flowing through the lenders. And they actually don't see it from the data they capture from any brokers in terms of RMAR, because what they don't see is your inquiry levels, who you talk to in terms of managing your sales funnel. And that's the big challenge, is that why should proc fees increase? Because you're having to do probably 2 or 3 times as much work as you used to have to do to get that one application started and into a lender. And I think that's the hard part of the job now. And there's not an appreciation, I think, of how much work is involved in all of that to get there. But that's driven by this mortgage applications numbers. How's that dropping in the current environment? Interest rates where they are, people should be flooding through our doors and going berserk. And it's not happening for some reason. And it's because, we've seen this over 10 years, gross mortgage lending. This was silly. This was a silly number. We should never have been up there. This is the number we should be at, 250,000, 250 billion. That's about the right number. Mortgage turnover about every 5 to 7 years. That's about the right number for the market. Inflation adjusted, God, it should be close to 300 actually, but that's another matter entirely. But you can see gradually the trend line of gross mortgage lending is upwards over the country, and it's dropping, but it's running that way at the moment and dropping back down. I expect if we run at current last 6 months run rate, gross mortgage lending from September to September is liable to be around 185 billion. Not the 225 people are predicting. Some interesting things happening within the market around that. But Scotland's no different to the rest of the country. So, total lending in Scotland, high. And you can see that we always have that interesting Q1 because of what happens in that lead over the back end of the year. But the numbers are gradually going nicely in the right direction. Looks quite positive. Remo? That's the bit that should be working. Why is it not? Is it because we created too many mortgage prisoners? Is it because the self-employed can't get a mortgage? Is it because they're all interest only? What is causing this? The economists are really confused. The PRA is confused. The FSE is confused. Is it because lender criteria is just too strict? I ask the question. Have they gone to the wrong place in terms of MMR? Have they overcooked it? Because first-time buyers, they're flooded back because of the government assistance. So that's working. That's the interesting part for me. That's looking good. And we can see this first-time buyers, a percentage of house purchase loans, is just been going upwards and upwards and upwards. So all looks okay from those numbers on a macro level. But we can see where the problems might be. And we can see that this trend line on rates means that everything should be working really positively. But it's not. So I can only point my finger at one group of people. Because I think some people have got affordability over-egged. And it's rationing, and it's all those kind of things, and we're going to see some interesting things happen in the second half of this year. Aren't we, Mr. Cochrane? And I think this is the challenge, because there's this worry as well. Are too many people borrowing now above 35% LTV? Well, I don't worry about it if people can genuinely afford it. The LTV is only a problem if you have to liquidate the bloody property. But as long as it's affordable, it all looks okay. Because even these trend lines are ones that, from my perspective, that's bound to be happening because of what's the government intervention. The rest of these lines actually look about normal, but no doubt Linda might have some numbers that might run counter to that because she's got more structural data from the lenders than I have. And this is ultimately it. Help to Buy has been working across the country. In Scotland, in England and Wales, and to a degree in Ireland, because this is an initiative that has had to work to operate to make the world a better and more structurally sound place. And will no doubt continue for some time yet as governments decide that they want to get away from building 100,000 houses a year to build 200,000 a year. And they can only do that with an awful lot of injection to give builders the confidence to build. Okay. My last slide is the one that worries me most. Because if you give clever people a toy, they will want to play with it. And they did. Because giving the Financial Policy Committee the toy of LTI caps, what might they do? And might they start to play with debt-to-income caps? Because that's the other problem. When you go back and look at that slide about overall indebtedness, do they want to try to control debt-to-income in order to try to avoid the situation where too much money flows out of the economy to service debt? Because what we thought was, when they brought in this LTI cap at 4.5 times, get 15% of the book, everyone went, that shouldn't cause a problem. Until you've got our dear friends at Barclays Private Banking flooding through a whole load of mortgage apps into their book that suddenly puts them close to their limits. And what's since happened then, of course, is Barclays Private Bankers are clever, intuitive people who suddenly say, well, I can't put it there, I'm going to put it somewhere else. So they've been running around the city trying to find other banks to place it with. And that won't stop because the demand doesn't go away just by putting the cap in. So then you see Santander beginning to put a cap in first-time buyers and TSB introducing a cap because it's this domino effect that as one big player pulls away, other people begin to get swamped. And that's where we are now. But the heat has come out of those markets. House price inflation is on a downward curve. And if we start to play with DTI caps, then what do we need to do? So what's the solution? Well, I think if you actually move that 15% to 20%, the problem goes away and it won't actually bring house price inflation back. Because I actually think house price inflation has just about gone out of the market now. So there's debate about how that works going forwards. But we will have to wait and see when the FPC next meets in in April, when that plays out, to see what decisions they make. But that will be an interesting meeting of a group of people who've got some very difficult decisions to make, because having put it in, to state it, we take it back out, we admission of failure, and a financial policy committee can't have an admission of failure. And that's where we get to an interesting place.